Well, thank you very much. Welcome to This Week in Venture Capital. Very happy to film from New York this week. It's the first time we've actually filmed in New York, and we have Mo Koyfman here from Spark Capital. Very happy to have you.
Thanks for having me.
Yeah, very happy to have you today.
Glad to have you in New York.
Yeah, no, it's great to be here. You know,
you're bi-coastal now.
I don't know. I was just in China 2 weeks ago, so I feel like
you two call that tri-coastal.
I don't know where I am. The time zone. The only thing I do know is I'm not sleeping.
At least we're somewhere, right?
Yeah, exactly. and I have to tell you that New York is hot right now. I mean,
and not just the weather.
Not just it is, yeah, but it is hot out. But what I'm hearing in Silicon Valley is people are telling me that they're either establishing offices or outposts, or they're doing a lot more traveling out here. They're doing a lot more early stage deals out here. And yet LA is only an hour flight. And I'm not saying they don't come to LA, but New York has this buzz about it. Is that right?
Yeah.
Sorry, you're based out of Boston.
Yeah, the firm's based out of Boston. I'm in Boston a bunch, but I also spend a bunch of time here as well, and have been a kind of native New Yorker. I grew up in the burbs, but have sort of been in this market and worked in this market for 10 years before joining Spark, so I have pretty deep roots here. Yeah, I think New York is hot. I'm a little bit reluctant to jump on, to jump the shark and jump on the bandwagon a bit too much. I think it's been bandied about pretty significantly in the community. I think there are very specific reasons why New York is hot. I think there are specific reasons why New York is hot versus LA.
Yeah.
I think there's a very deep entrepreneurial culture that exists in this city and always has. There's an immigrant culture. I've been reading a book lately that's kind of in my head about this new creative class that gravitates to markets like New York, and I think I think there's a core base of folks here that are driven to and pulled by entrepreneurship. I think historically it hasn't necessarily been pointed at the same sectors that we invest in, but I think increasingly it is, and there's a whole bunch of structural reasons about why.
So, and I'm gonna come in a moment to introduce you, and we should do that. But since we're on this thought of New York, I'd like to follow up on it, which is, so I hear it's hot, and I've been here now for 5 days, and I keep asking the question like, how's VC, how's tech, how's entrepreneurship? And despite the gloss of what you read in the headlines front of New York Magazine, obviously you have Foursquare and Tumblr and some high-profile companies. I'm still hearing a lot of people saying there's not enough venture capital here. I'm still hearing people say it's very hard with tech resources because you're competing still with Wall Street and the salaries that can draw in. Is that true? Or, there's still some challenges here?
I think there are challenges here. I think there are challenges everywhere. I want to take the kind of people point first because, I think that's a challenge regardless. I talk to people in the Valley. I talk to people in San Francisco.
I guess you have companies of mine. You have the Google effect.
Yeah,
right?
Well, for Google, Facebook, Twitter. Companies just sucking up the talent.
Yeah.
You talk to people in San Francisco. They say, "Gosh, we should have located our office in the Valley because we can't get any developers here in San Francisco."
Yeah.
I think finding great people is generally really, really hard and very competitive in any market that you're in. I think New York is no exception. I think Wall Street is still a draw, although I think the bloom's off the rose a little bit in terms of the tech and new media and internet's ability to kind of grab those people. But I think I think what's happening, this is kind of a larger trend, is that with the costs of startups, at least initially, coming down, shared leased infrastructure, et cetera, the cloud. I think you're seeing a lot more companies born.
Yeah.
But they all need like a couple front-end guys, a couple back-end guys. They all need a UX and a design guy.
And those people are earning good money, aren't
And those
they?
people are making good money, and finding a really good UX or design guy, like you know how hard that is.
And what about this, Mo? Okay, so like UX, I think is going to come from New York or LA or San Francisco in the sense that it's a design skill, right? But one of my favorite New York early stage entrepreneurs is a guy named Ari Jacoby. Do you know Ari?
I do.
So he's my kind of entrepreneur. And I think he's doing, if I'm not mistaken, and I hope I don't quote this wrong, but I think he's doing a lot of his development in Philly. So he's got ad sales and operations in New York because he's serving the media sector, and yet he can hire people on a more affordable basis with a lower churn rate. Do you ever see that? Is that a trend, or is it a one-off?
I think there are people doing it in that way. I know I was talking to another someone else in the business last night and talking about how the talent in Russia is so prolific on the engineering side. I think you can have outsourced teams. I'm involved in the business right now. We're talking about kind of leveraging a whole bunch of outsourced resources in Eastern Europe. I think it really depends. I think when you're doing consumer web, specifically on the front end stuff, specifically on the product stuff, you really want those people close to the CEO.
Yeah.
And even just the basic architecture, it really depends how you construct your team. There are some companies, we have a couple Israeli companies.
Yeah.
There are some where it works better than others, having R&D in Israel and the rest of the team here.
Just to take a case in point, you guys are an investor in Boxy.
We're an investor in
Boxy.
Yeah.
has a lot of its R&D in Israel. Talk about how that works.
And 5min as well,
right.
Which is another company in New York doing quite well. It's great. It's helped build a tremendous product, but over time you end up in these situations where you try and figure out, what happens there, what happens here, how do we organize around that most effectively? And I think that's just the nature of any company that's growing with kind of multiple, with overlapping functions in multiple areas. So, I don't think there's a blanket answer for it. I think it can work for a lot of companies and not work as well for other companies. I think in the consumer web, it's harder than the enterprise, where you can really segment out some of the development activities a little differently.
What I like to tell people, Mo, my advice is head of engineering needs to be with head of product management, needs to be with CEO. And I don't think you can break up those three now. So what I've always believed is you can have some amount of development done in multiple locations. Yes, there are tools you can use these days, and you can have rock star developers. Maybe they want to stay in New Mexico, as is the case of a company called Collecta, and you can make that work. But I just think that if you think about customer development, where you're constantly listening to what your customer is saying, getting the feedback, feeding it through product management, getting fast turns on engineering, those three have to be in the same
I
location.
think that's ideal and probably right for both consumer businesses and enterprise businesses. I think having the kind of the brain center of product and engineering kind of in tandem there with the CEO is ideal. It's not always the case, but ideally, that's kind of what I was alluding to before. When you can segment off pieces of development teams and activity, that's one thing. If the entire kind of product and engineering operation is somewhere and the business operation is somewhere else, I think it becomes trickier to really all be on the same page. And those are, it's manageable, but far from ideal, I think.
So we probably should have introduced you up front. Mo, you are rare in the VC world in the sense, or at least in the minority in the sense that you had operational experience before. You graduated undergrad from Wharton?
Wharton and the college at Penn.
Yeah, so it's funny, my wife has an MBA from Wharton, and she tells me the really smart people are the Wharton undergrads.
Well, it's funny, I'll tell you something about that, and I think it's relevant, is I did, Penn's an awesome place for a number of reasons, one of which is they have multiple schools. They have the college, the business school, Wharton, and the engineering school. I did two degrees when I was there. I did a BA in English at the college and a BS in finance at Wharton. And I'm actually pissed I didn't do an engineering degree, but that's another story for another time. Yeah. And my dad's an engineer, so I really have no excuse, although maybe that's why I didn't do an engineering degree. Anyhow, the beauty of that was I was able to study literature and liberal arts and all that good stuff while also getting a finance degree. And I will tell you that not just in my personal life, but in my professional life, I think that the liberal arts degree has served me as well and probably better than the finance degree.
So I'm going to echo that, which is I had a double major undergrad. I studied economics and political science, and it was my hedge about business versus law school.
We all have one,
but,
right?
I grew up in the LA law day. It was like sexy. You wanted to be a lawyer, God knows why. Ultimately, if I think about what came from poli-sci for me, critical reasoning, which is important in business, and writing and communication.
Same in literature. Yeah. It's how to think and how to communicate. And those are very, very, very powerful things.
As long as you're mathematic, the finance stuff isn't that hard
to
pick up. I find it ironic. There's a nice irony that you have a BS in finance.
Well,
irony?
Absolutely. But I will tell you that the finance stuff, I came out, and like a lot of my classmates at the time, I worked at a bank for a couple of years, and I had a lot of friends who came from Hamilton and Wesleyan and they didn't learn any finance there, I promise you. And they, 6 to 9 months in, were doing the same high-level math and analysis and we're as good a spreadsheet jockey as anybody in the business. So, I think you can learn, those are mathematical disciplines that you can learn. You're not talking about really, really, really complex stuff at the end of the day. I mean, it's still pretty confined in terms of the kind of math that you're doing. And I think it's much harder to teach somebody how to write effectively, how to communicate, et cetera, et cetera.
And Penn and Wharton have been getting a lot of attention lately. I think the Invite Media guy.
Absolutely, it's a topic du jour, and kudos to those guys, and really psyched for them. It's really great to see young entrepreneurs come out of Penn.
How old is the guy? Is he 24 or something?
At best,
At best, okay.
I think so, yeah.
Gotcha.
There are two of them, great guys, and it's just great to see. And I, been talking to a lot of folks in the community, of kind of reading it on Twitter, et cetera, and it seems that it's not just them, but there's a handful of great entrepreneurs coming out of Penn.
I just funded, and I can't talk about it yet, but a very young entrepreneur out of Wharton.
Great.
Undergrad. And one of my personal favorite, for personal reasons, companies in your portfolio, the CFO is a Wharton undergrad. It's called KickApps.
Oh, yeah.
David Lapter.
David's fantastic.
Yeah, I love David. And he and I worked together in London. He was my CFO at my first company.
You know what? I remember that, actually.
And he formerly worked with GRP. Actually, he went the opposite way of me. I rescued him from the dark side and brought him over to operation. He's loving it.
He's as good a CFO as we have in the portfolio. He's fantastic.
And tell me about KickOps, and we're just like all over the map here, and I promise I'll tighten it and bring it back. But Ning, I originally thought, when David told me about KickOps, I'm like, that sounds like a really interesting company, but Mark Andreessen, Ning, they're kind of going to kick your ass. And Ning just has gone nowhere, and KickOps seems to have moved in a different direction and get more focused and win a lot of customers. What's going on?
Well, KickOps, again, another New York company, so should give them, give a little more props to the New York market. I think a lot of it is a product market fit thing, and kind of where you point the product. KickApps started going at the enterprise, which is a much harder sale, far longer sales cycle, as we know, but bigger deals, more predictable over time. It's kind of a different customer base, whereas Ning went at the consumer in a different way.
And Ning went after the free white label social network.
Correct.
And eventually they gave that up and moved only to paid, right?
Correct. And so KickApps went at the enterprise with a paid model. Ning went at the consumer with a free model. And KickApps got traction there, and now is moving more downstream towards, I wouldn't say the consumer, but more the small business.
Right.
And they've actually widened the product set, so it's not just kind of a social CMS or social media tools. It's really an entire kind of web development kit.
Right.
And we've seen another non-Spark portfolio company, but a great company in New York who's been very successful, actually two of them, one Wix and another called Squarespace, that have done a great job with a software as a service model for SMBs, online customer acquisition. You can reach SMBs now much more effectively on the web.
Yeah.
They think, that the typical person running an SMB goes to Google and types in what they're looking for, just like a consumer does.
Although the one warning sign, Mo, that I give people who ask me about SMB all the time, what you need to think about is, does the SMB have a person at that company whose job it is to implement your software? Because what often happens is they don't have the skills.
I agree with you.
And they sign up and they'll pay you, but they won't get the value. And if they don't get the value, it's hard to scale.
So what we're talking about here is mission critical software.
Yeah.
I mean, this is a whole different world. We're talking about running your website.
I know.
So if you're an SMB and you need a website, and you're going to transact and conduct business through that website, and you're going to find a provider, and they're going to host it for you, and they're going to provide you the platform. It's different than a performance management tool
But so SMB, just to be clear, that everybody knows, is small and medium-sized business. And so maybe we're talking more about MB. And then they kind of have this classification of SOHO, small office, home office. But what it seems every company I know who has a 24-year-old founder wants to target bars and restaurants. Because that's what they live in from the
maybe in New York,
but just everywhere, LA, San Francisco,
big cities,
and it's very hard to reach these customers. And I did this analogy, I wrote about it on my blog, which was elephant, deer, and rabbits. and it's how much meat is on the animal that you hunt. And I always say startups should focus on deer, because if you get an elephant, let's say you land AT&T as a customer and it's your first customer, oftentimes your company gets subsumed into serving the big guy. What I worry about in SMB is too many companies have this mistaken belief that I'm going to sign up all these bars, I'm going to get all these rabbits, and they look so easy to catch. They're fast, and when you get them, there's not that much meat.
But two things. I want to talk about the rabbits, and I want to talk about SMBs.
Yeah.
The other thing about the rabbits is they're very promiscuous.
Yeah.
They like to sleep around.
Oh, that's interesting.
And so when you get one rabbit, sometimes you get another rabbit.
We could venture into some pretty bad
Sometimes
areas.
you get another rabbit, and they're very viral creatures.
Okay.
And so there's a whole other effect that you get if you tap into the right vein with the rabbits, that all of a sudden you got rabbits everywhere, and then then it's more like rats or mice even.
Right, right.
Can't even get rid of them if you want to.
Right.
So it is a little bit more of a lightning in a bottle thing, but when
Yeah.
you catch it, it's pretty
It can be
incredibly
big.
powerful.
Like a Zendesk seems to have tapped
Well,
into
now
it
I'm
a
thinking
little
in the consumer side, like a Foursquare or.
Oh, no, but the difference with Foursquare, the difference, in my opinion, I mean, you guys are
We're not
you're not
investors.
investors, so we can talk more openly then. The thing with Foursquare is,
Although we're big fans and
Yeah.
love Dennis and the guys, love the product. But
yeah, no, and I wasn't going to critique. I was more going to say Foursquare focuses on the consumer, and by having the consumer and driving the consumer to venues, they can engage those venues in a different way.
So let's talk about SMBs, because I think, I didn't mean to veer us away, but I think it's an interesting point about whether you go elephant hunting or not, vis-a-vis the consumer. With SMBs, I think that the web has democratized. It used to be the big black sinkhole in the business, like SMBs, they're impossible to get.
The only one who ever got them was Intuit.
No, you can't invest in a Salesforce because they can't get them effectively. It's going to cost too much money. The unit economics don't work. It's just a sinkhole. I think today you can acquire those folks much more effectively on the web directly.
Especially in a Facebook world, right?
Facebook, Google, these folks are on the web, they're searching for answers, especially for when it's stuff that's mission critical.
And now you have Reach Local, who's got feet on the street helping
all
them get
other
online.
ways to get to them. And by the way, I'm not just talking about offline local businesses. I'm talking about they could deliver their service or product on the web as well. There's all different types of small and medium-sized businesses.
And even just thinking more about New York, Etsy and people like that who are engaging
enabling small merchants. There's lots of and there's lots of different ways to go out and acquire those folks. I think also over time, what you see with these businesses, I think Salesforce is an instructive example. I mean, we've talked about this before. You know, it's a bit of a myth, but they did start lower and move up the chain. I think a lot of these companies can move up the chain over time as their product gets more sophisticated and they work with more customers and they understand the ins and outs.
What I would tell any entrepreneur watching is if you haven't read The Innovator's Dilemma, you need to.
Absolutely.
I don't know, have you read it, Clay
Yeah,
Christensen?
this is a classic disruptive idea.
And the whole idea is you start with a lower price point and lower functionality and serving a lower end part of the market, because you're not going to compete with the big player who has deep functionality and deep R&D budgets. But over time, as your product increases and you have a delta in what you charge versus the very large customers charging, eventually they trade down because the value is enough.
And it ties into the minimum viable product thing. It's like identify a very clear customer, go at them with a very specific product that fills their need, and expand. And I think the same is true for the product as it is for the market itself.
And we never got past Wharton with you, and in fact, I'm glad we didn't start with elementary school. But you went to work in banking for a little bit, but you really cut your teeth, I think if it's fair to say, at IAC. Tell me what you did at IAC.
So I I did the bank thing to learn, and I was mostly doing media and some internet and early internet stuff. But mostly large cap media, primarily M&A, big transactions with like the likes of News Corp and Time Warner, and then we were actually looking at a bunch of early internet stuff. This is end of 99, 00, 01. It was like up. It was on the way down at that point. So kind of a lot of broken assets, a lot of kind of interesting things. And I just knew I never wanted to be a banker. I did it to learn, to meet people, to get a good. Continue my education, really. And I just was fortunate enough to have the opportunity to go work for IAC. At the time when they had spun their media assets off, or were spinning their media assets off to Vivendi, they had $4.5 billion in cash.
And what did you do? I mean, you weren't
Yeah.
like in the corp dev
So
or
I started
acquisition group,
there.
Oh, you did?
So
Okay.
basically what happened was they had all this cash. Barry wanted to refocus the company on
That being
interactive,
Barry
Diller.
Diller. Yeah.
And there was like a team of anywhere between 5 and 7 of us that effectively said, okay, we had to like look at the internet and start with the strategy, the strategic planning, like what are the interesting areas of opportunity. They were very focused on commerce because they had HSN, Home Shopping Network.
Yeah.
Big business for them, and television. Barry had been convinced for years about the web and all of this.
And other big internet properties, just so people know, they had City Search,
Ticketmaster. We didn't have Ask yet.
Oh, you didn't have Ask.
We bought Ask. City Search, Ticketmaster. We just bought Hotels.com, Expedia.
So pretty big properties.
Yeah, and then we, that group ended up buying LendingTree, Hotwire, Service Magic.
So this is a pretty big internet player.
We probably did. We did. I don't even know how many acquisitions when I was there, from small to large.
When I see investment banker presentations and they talk about viable exits, and obviously Google and Microsoft and Yahoo are on there, but IAC is always on the list. As small companies should know. But IAC is kind of like smaller price.
It is. I mean, I think, I don't
want to say bottom
tier. Well, Barry is very disciplined.
Right.
He does not like...
Is disciplined a code word for cheap?
Maybe. He doesn't like to overpay for assets.
Which is another code word for cheap.
Yeah. And I think he's cheap in sometimes a good way and maybe sometimes a less good way, where we should have paid up for things that we didn't.
Yeah.
That's a longer conversation. But the reality is he searches for value. But in that time, this is like 01, 02, 03. I mean, there was a lot of value to be had. 04, and we were, I was doing everything at that point from minority investments in companies all the way to acquisition. So that's where I started.
Did you have an operational role eventually at IAC?
So I started learning I learned the investment trade there, and then kind of migrated when prices got really high. Barry got sort of frustrated and wanted to build some stuff, and I broke off with my boss at the time. We started an incubator, and we launched a couple businesses out of that. One of them is Pronto, which is a shopping search business here in New York. Another one was Gifts.com, came out of that group that was kind of subsumed by Pronto as well, run by a great guy, talented guy in New York named John Foley right now. And then ultimately, I started moving more towards incubating stuff, and then I found myself starting this new kind of area of the company focused on digital media, which was a passion of mine. And a gentleman named Michael Jackson came into the company who had worked with Barry previously, came from television background, different Michael Jackson. And we started trying to figure out things we could build, things we could buy to build up the digital media portfolio. And I ended up leading an acquisition of a company called Connected Ventures, which is the parent of collegehumor.com, which is the leading independent comedy and really young male-focused content site on the web. Busted Tees, which is a retail business, and Vimeo, which is kind of really taken off as the leader in sort of video sharing. It's kind of different than what YouTube does.
And am I right to say, were you COO there, or did you have
so
an
basically,
operational role?
I first bought the company, and then for IAC, and then I really wanted to get closer and closer to the operation, so I joined Josh and Ricky, who are the co-founders, to help them run the business. And was there for a while before I left.
And you joined Spark Capital in September 2008. I'm going to talk about that in a moment, but let's talk about Spark. Spark seems to have come out of nowhere. It seems to be one of this new breed. There's a new breed that everybody's sort of talking about and has a certain brand cachet for being involved in high-profile deals, whether it's Twitter, whether it's Boxy, whether it's Tumblr, whether it's, as we talked about, AdMeld. Tell me about when was Spark formed, and how has it arrived on the map so quickly?
So Spark was formed in 2005, and you think you have to give a lot.
Which in VC terms is not a long time.
No, I mean, we've been around, this summer is 5 years, which is very young for a VC firm. But the two founding partners, Todd and Santo, have a very long history in the venture business. So it wasn't, Todd...
And Todd had invested in Akamai, right?
Yeah, Akamai and Qterra and a handful of very meaningful exits while he was at Battery Ventures for 10 years. Yeah. Santo was at Charles River before, and back in the day was at BT Ventures. So these guys came from a venture pedigree. So they weren't starting carte blanche. They had history, track
Right.
records, relationships, etc.
Right.
They brought in a couple other guys, Bijan, who you know,
Yeah.
and we've all spent some time together. Kind of came more from an operating background, but has spent the last 5 years, I think, just done a tremendous job transitioning into a fantastic VC, and built the team out around that. And Alex, who had also joined and had worked with, has a VC background as well, and had worked with the guys before, knew Todd previously, and the team kind of congealed. I think, why successful? I think part of it is also the focus. So Spark came out with a very specific focus on media, technology, internet businesses, and kind of this thing we call the conflux, which is the colliding of all of technology with these industries.
And you are, I think it's fair to say, stage agnostic, maybe a little bit more early stage, but stage agnostic.
Two things. So within that kind of conflux, as we call it, we kind of start with the consumer and then work our way backwards in the chain. But we do invest in the infrastructure underlying sort of the value chain, the cable plant, the mobile plant, et cetera, the wireline and wireless communications. And that's the background that Todd and Santo come from as well. They've done a lot of those deals in the past.
Right.
And so we're investing on the infrastructure side, but we're also investing on the consumer side. But we really start with the consumer and like what their needs are, what they're looking for, and then kind of work our way backwards in the chain and invest on both sides. In terms of our stage bias, I'd say that we are largely early stage investors, kind of seed and Series A stage investors, and then we kind of selectively will make call them venture growth investments in areas that we really believe in, companies that are leading those markets, and entrepreneurs that we really know, et cetera. And so we're a bit agnostic, but we're kind of largely an early stage firm with kind of a selective growth focus.
Is the same true about location, which is more investments in Northeast, but open-minded to national practice?
Yeah, we're very open-minded geographically. We've clustered in the Northeast and on the West Coast, sprinkled. There's a couple things we've done in Europe, but we really we make sure that it's a company we understand, people we know, work with co-investors that are great, et cetera, et cetera. But we do deals there as well. But actually our largest cluster is in New York. I think we have, I'm probably wrong on this, but it's 14 companies in New York now. And it's part accident, it's part not. I think Bijan really did an excellent job mining the market early. I think Santo did an excellent job as well. Todd and Alex both have companies here. I now have soon to be 3 companies here.
Is Boston as a market not as early stage friendly as New York is?
No, I don't think it's about early stage friendly.
Every VC that I saw, because I spent some time in Boston, and every one that I went to see said that they're in New York all the time.
I think Boston, look, it's no secret that Boston was an infrastructure town.
Yeah.
Largely, a lot of the guts of the web and mobile communications were funded out of and built out of Boston and out of MIT and a lot of the companies that came out of there. And by the way, that continues, but a lot of that infrastructure has been built already, and now it's incremental, and there's going to be new standards, there's new plant, there's new upgrades, there's lots of stuff to do, and that still comes out of Boston. I just think as it relates to the consumer web, I think there's great stuff in Boston, but I think we've seen New York rise tremendously. So comparatively, we're seeing a lot more stuff in New York, and that has to do with the nature of entrepreneurs here, the industries that thrive here, be it financial services, retail, advertising and media, et cetera, where there's been a lot of innovation. And I think people want to live here.
Yeah.
It's a fun, cool town, and I think that matters at the end of the day.
Boston's not cool.
No, I think it is, but
I'm totally kidding.
I know when I was
But I
graduating.
will tell you, Lakers are up 2-1.
I'm a Knicks fan, so
you are?
I got nothing to be happy about right now. I'm applauding Mayor Mike for the "Come on, Braun" thing.
Did you watch the game at all? Did you see
last night? I was at a dinner, but
Derek Fisher
he's
just
awesome.
Tore up the fourth quarter.
I put Derek Fisher in that class of like Robert Ory, Derek Fisher. Like guys that when it really matters, they come to play. They're gamers.
They stay cool.
Derek Jeter. I think Derek Jeter's on a different level.
Yeah.
I think Derek Jeter's but that's my own Yankee bias. But
I can't say this here because I'm a Phillies fan. So I'll try not to attack.
That's a National League, American League. Come on.
But honestly, Derek Fisher last night was just
he's awesome.
And so gracious after the game, and he almost was in tears
You got to give Rondo a lot of credit, though.
Yeah.
And he's a gamer like that. That guy is going to be a real gamer for a long time.
We could do an ESPN show after.
Listen, you know, Keith Olbermann called me this morning. I didn't want to tell you.
Yeah, okay.
No
He's
big
going to
deal.
bring you over. There
No
you
big
go.
deal.
I do want to, first of all, talk about a deal that you guys are involved with, because we're actually sitting in the offices today of Next New Networks. And this is a topic that's very interesting to me, not just in doing a web series, but I live in LA. I'm so fascinated by where media is going to be. When we think about the internet, it's both a communication platform and an entertainment platform and an education platform.
And a social platform.
But social, I think, is an element of the other things, right?
All the verticals.
But if I think about it, and I think we've had such innovation in Web 1.0, you know, not just a two-way conversation, but if I look at the Huffington Post and how instrumental that's been in changing the way news is created and consumed, and video, we're really just scratching the surface. Tell me about Next New Networks.
So Next New Networks is the leading independent provider of original programming for the web.
Okay.
They do short form and longer form stuff. They create their own stuff in-house, but increasingly they are working with what they call Next New Creators to help other creative folks out there make the stuff they want to make, get it up and distribute it online and monetize it effectively through channel partners like YouTube and other places on the web where there are big audiences, and also driving it direct. You know, they've been around for a little while, have established great credibility in that market. They've worked with fantastic people. It was started by a couple folks that came out of the business who really just had a sense for the creative world and for building creative assets. And you know, they're at that point now where they're really starting to scale both the video views and the number of the creators, and they've gotten the model to a point where they can bring the cost of making that stuff down so much, where the unit economics are starting to make a lot of sense. You know, video advertising, as we know, very much on the rise. CPMs are high and for good reason. And
do you know,
if
and
you bring the cost of creation down and you get scale, it's
kind of unfair to dig into the details on something that we didn't talk about ahead of time. But do you know, I mean, is a lot of the focus pre-roll, or is it rich internet advertising
it's both.
Around the video?
They do pre-roll, and then they do some other formats, and they're constantly testing and balancing the most effective ad formats for advertisers, you know, in terms of delivering audience for advertisers, and also in terms of what consumers, you know, being consumer friendly and making sure that they have a great experience. And that's the balance with any advertising in any medium.
Do you ever spend time on Hulu? Are you a Hulu consumer?
I spend a fair bit of time on Hulu, but I have to tell you, not a ton. Okay. I'm like a bit, you know, I don't watch a lot of television. I watch sports, as you probably picked up.
Yep.
And there are a few shows that I'm really into, and I will often just, if I can't catch them or DVR them, I pretty much DVR all of them.
Yeah. I
occasionally will buy them on iTunes, just have them downloaded on my machine, take them when I'm traveling, or going wherever for who knows what. That's sort of my use case. I definitely have been on Hulu and watch Hulu a fair bit, but it's not my...
The funny thing to me about Hulu and advertising is I am a consumer of Hulu, and it tends to be, if I watch something in serialized format, the biggest thing that's drawn me away from Hulu is I used to consume The Daily Show on it, right? And I'd either DVR it or I'd watch it on Hulu, and it's not on Hulu anymore. Or maybe was it on YouTube? No, it was on Hulu. And now I'm just trying to remember for a second. Now I watch it on Comedy Central. But that wasn't what I wanted to talk about. Was they always say that they're sold out, always. And yet every ad I ever see on it is a combination of one of two things. Either a schlocky ad, and I don't want to name the firm, I usually do when we're not on film, but there's this one firm that always advertises. It's like a little crappy internet company like that advertises, or it's PSA, a public service announcement. And you can't tell me you're completely sold out on inventory when you're doing schlock.
You've raised money before,
PSA,
right?
Yes, yeah.
Scarcity value.
Yeah.
Everybody wants into what they think they can have, right? Yeah. And same with a company, it's same with a fund, it's same with advertising.
Yeah.
The the more
So there's
demand
too
that you
much
can create.
inventory? Or?
No, I think that it's demand creation tool. Like
Okay.
they create scarcity value. They're trying to let advertisers know and the community know
Okay.
that Hulu is sold out.
Okay.
And if you want Hulu, you're
Yeah.
going to have to pay $30 seat, whatever the number
But
is.
like, come
15.
on, advertisers must log on to Hulu and say, well, how are you sold out
They
if you're running
do.
freaking PSAs again?
They do,
Yeah.
but you know.
I mean, I want to
it's
save
all
the
part-
forest like anyone, but
It's all
come
part.
on.
It's all part of the game, you know.
Gotcha.
And until we move to a world where the whole thing is end-to-end digital, and I don't think we're that far off from it. And you know, we were talking about AdMeld before,
Yeah.
a portfolio company of ours in New York that's just killing it.
So tell everybody what AdMeld does.
AdMeld is the leading real-time bidding exchange, or one of the leading, I think the leading real-time premium real-time bidding inventory exchange on the web. So effectively, premium publishers put their inventory into the system, and in real time, advertisers can go and bid on that inventory. They can append all kinds of data to it.
Sounds like it's the reverse of Invite Media. It's
well, no, Invite Media is a big customer.
Invite Media, if I understand it right, is a DSP, which means it's helping the advertisers buy and creating behavioral data and buying opportunities to buy.
Yeah, it's a demand-side platform.
Yeah, demand-side platform.
Which helps
demand meaning
advertising, which helps them
But
buy.
AdMeld is more publisher-centric, isn't it?
It's both.
Oh,
It's a marketplace.
Okay.
And so
but it's
it
not
started,
an exchange.
It
it's
is.
Not, oh, it is.
It is.
So they compete with Right Media and
Yes.
with AdECN
Yes,
and with
Google.
Google.
Correct.
I'm sorry, I didn't realize
Yeah,
that.
well, they started, it's probably because
I thought it was closer to Rubicon.
Early on, they started very much like Rubicon or Pubmatic,
Yeah.
working with premium publishers. Specifically, they had a great selection of premium publishers they were working with to help them optimize their remnant inventory.
Yeah.
Over time, they realized that it was far more efficient to...
I just want to make sure remnant inventory is that inventory which isn't sold. Yeah, premium inventory, which your direct sales team is normally selling.
It's the kind of inventory that Hulu doesn't have.
Allegedly.
Allegedly. So,
but I love Hulu, but I don't understand this freaking thing about saying you're sold out. Anyway, guys, I know you're not sold out. But so
$5 CPM.
Yeah. So you started by doing that.
So anyhow, they started by doing that. They moved to really be a marketplace because it's far more efficient for both sides of the equation to run that inventory through a real-time bidding marketplace. And the demand-side platforms like Invite sit on the demand side, which is the advertiser side, and they help advertisers, buy inventory in real time off those exchanges by appending data on those users, intentionality data, demographic data, all kinds of segmentation. It's getting more and more sophisticated through cookies and pixels, et cetera, et cetera. And the way that market is evolving is fascinating.
You know what I found really interesting is when you think about every website today uses Google Analytics.
Until Omniture upsells them.
I was going to say the top end of the market uses Omniture, but what I meant is, let's call it the long tail.
Yep.
Uses Google Analytics, which is a free product. And having Google Analytics lets you track your referring traffic and how it converts and how many people come and so on and so forth. But Google Analytics, like Google in general, is dumb. And what I mean is, it doesn't know who you are.
Oh, and garbage in, garbage out problem.
Okay, so I won't say it's complete garbage. They have data,
but
they're dumb relative to who you are. And what interests me is Facebook this week released an analytics product. I'm told, I haven't played with it yet, that it'll do similar stuff to Google, but instead it'll actually tell you, if you log in with Facebook Connect, information about the people. So now I don't only know who referred you and how did my traffic spike and what content did you consume. I knew that you're a 28-year-old woman who's engaged to be married, whatever.
Yes, and so there's two ways in which products like Google Analytics can be dumb. I use the term loosely, but one, if you don't set it up correctly to track the right things.
Which nobody does.
Which most people don't do, because it's actually, you got to get in there.
Yeah.
I mean, I remember doing this for Vimeo and College Humor. It's like, we actually, we had hired a consultant to help us structure this thing because, I had some friends at Google who were helpful, but it's a free product. There wasn't a ton of customer support.
Yeah.
There's some pretty sophisticated stuff. This is going back years that you could do with it, and increasingly so. Yeah. And especially as you go into the higher end analytics packages. And if you don't set it up correctly, you're just not going to get the value out of it. So I think that's number one. You really need to make sure you're getting the right data in, and then
and
secondarily,
importantly, Google doesn't know who you are when you're
right,
there.
and then secondarily, to your point, adding data on the individual, I think, is incredibly powerful, and we could get into a really long discussion on Facebook and their value as a company and the ad network that they're eventually building and what Connect is really all about. And we could talk about all that stuff.
Oh, we won't.
But we won't. But I will just say that, yes, having a lot of data on who individuals are is very, very powerful.
Yeah,
and what they do and what they read and what they're interested in and who they're friends with. That stuff's pretty powerful.
Life is scary.
Or open.
Tell me about the Spark Capital website.
That was a source of real.
My read is it's irreverent in a kind of nice, funny way. Like if I look at Sequoia Capital, I'm like,
well, that's irreverent in a different sort of way.
I'm like, I don't get it. Like I understand you're trying to emphasize I guess it's about search or whatever, but for me it
says we're the firm that invested in
Google. That's what I read in it.
That's what I see.
That's what I read in it. But it doesn't make sense. But
you know what? If I was the firm that invested in Google, I'd
Sequoia Capital, however you rank it, is in the top 3 venture capital firms over the last 40 years. So I'm not taking anything away from them. Website, not so much. But Spark Capital, I love your website, and it's really irreverent and interesting. How did that come about? Is the culture of your firm irreverent?
One is, I think it does reflect the culture of our firm. I think, we're a bunch of different personalities that come together and somehow work in a symbiotic fashion. I think actually it's part of what makes us work is that we're all so different.
Who led the project?
Todd led the project, and Todd is, if you know Todd, is a very smart, very funny, very decent, good, irreverent guy.
Okay.
But I think the character of our firm is we have personality, and we wanted that to come through on the website. We had a horribly shitty site before we put this one up.
Did it feel like a lawyer site? Because most VC sites feel like lawyer sites.
I shouldn't say this because Santo literally built it, and he's going to kill me if he sees this. It was great for Santo having built it, but being the resident coder, computer scientist in the group. But the engineering guy in the group, but Todd really took on this project, and everybody was kind of giving him a hard time. You know how venture firms are with a thing like a website. But to his credit, and it really came out great. And I think I think there's a lot of money out there, and at the end of the day, we differentiate ourselves as people. And
your website says something about your personality. I mean, First Round has launched a new version of their website where they have their Twitter stream. They all blog. That says something about the firm. True Ventures does something that I really like that we plan to copy, which is you're supposed to rip off.
I copy a lot of stuff from True.
As do I. And they've what they do is they take their portfolio companies who list the lawyers that they like, and this interim CFOs that they like, and the recruiters that they like, and they don't have to put a true stamp on it and say we chose Joey Tran over someone else, but they just have the portfolio. That's helpful.
That is actually something that constructive criticism we haven't done the best job at, and it's on our roadmap to do more of for our portfolio companies. I think we've been a little kind of short-staffed on that front.
You can copy me. Just kidding. I'm going to copy True.
Listen, I'm down to copy anybody.
Yeah, me too.
The USV guys did an interesting thing. They took a portfolio company of theirs, Indeed, and they basically did for all their companies, they used an Indeed search for all the available jobs, right? So they're using a portfolio company. They found a very Web 2.0 kind of low impact way to do job listings without having to constantly get people sending you resumes or job specs or whatever the case may be. So I think that's important. I think we need to do more of that as well.
Gotcha. And I do want to talk about deals this week, and I do want to talk about our sponsor importantly. But just in case anyone doesn't know, and I didn't want to emphasize it because it gets talked about all the time, but Spark Capital invested in Twitter very early.
Yeah, it was the B round of Twitter.
B round.
It was after USV did the first institutional round, and we did the second.
Yeah, but it wasn't the $100 million plus, $1 billion plus round. And you also are an investor in Tumblr. So a lot of Boxy and other companies we talked about. But let me just take a moment to talk about our sponsor. because that's what pays for this to be on the air. It's a company called PickClick. I've talked about it every week, but I enjoy talking about it because it's a neat product. It's PICCLICK, PickClick.com. And the idea behind PickClick came from Ryan in San Diego, who said a lot of the way that you consume and find information on the web these days is difficult. You go and you look through listings on eBay, on Etsy, on other products, and he created a visual metaphor for searching for that. And my analogy always with this is, do you remember the old days, Craigslist? I don't know if you ever used Craigslist to search for a flat or something like that, an apartment or a house. And you had to search through that, and then you had to go to Google, and you had to then kind of plot it on a map. And there was a website called housingmaps.com that did a mashup between the two where you could visually go search for what you wanted to. And I think that was the original company that people started talking about the word mashup on. I think that's what popularized, they didn't create the term mashup, but I think that's what popularized it. And PickClick's kind of doing some of that. So right now on dating, you can go and you can search for your woman of your dreams on using PickClick, which is really just a front end. Originally for Match.com, they switched over to Plenty of Fish. If you're searching for recipes, and I don't cook, I eat. But
I do both.
Yeah, you do both. So if I don't know if I was cooking.
More of the latter than the former.
Okay, and if I wanted to make, I don't know, what's one dish you like to cook?
Oh, all kinds of stuff, but
like a casserole.
No, I don't do the casserole so much. I'm more into like grilling meats, and fish, and kind of healthy, good.
So you want to do a nice grilled fish, and you want to kind of find a good recipe for Dover sole. You can actually type it in, and what they
fancy on us.
What they do, I lived in England. Dover sole was big there, and what they do is they do a front end for I think it's allrecipes.com, and that helps you to drill down and find the information. I'm a very visual thinker, so I think the idea of a visual metaphor is good. So they're our sponsor for our show. They've had a lot of success and with the sponsorship, so they've actually started sponsoring 3 of the other This Weekend shows. And if you want to sponsor, you can sponsor, and you're going to like this, by typing in Mo, M-O, at thisweekend.com. That will not go to Mo Koyfman, but the gentleman who handles advertising on behalf of This Weekend is Mo.
Well, I think it's also important to let folks know that the show is sold out.
Yeah,
so
it is sold out. We're only premium inventory, no remnant, no PSAs. Advertisers.
Sold out. If you want in, going to be tough. But I know
Come
a guy. No big deal.
Let's talk about some deals. I usually have something I call Deal of the Week.
Yeah.
And it doesn't mean it's the best value of the week. It's just something that really interests me.
Okay.
And what really interests me this week is a deal called Book Renter. Book Renter, I actually saw before they raised their A round. Young gentleman out of Google had founded it, come up with the idea, had brought in a senior team. He was... I don't want to say struggling to raise capital, but it didn't like walk in the door right away. Partially because there was a much bigger, much better finance company called Chegg, C-H-E-G-G. The idea behind Chegg, the idea behind Book Renter is if you take college students who want textbooks, and the textbooks are the same for many years in a row, do you really want to spend $85 on a textbook when some other schmo just had it last quarter and can sell it to you for $40?
Right.
And the idea is, behind the model, is you can get 4 or 5 turns on a book, meaning they could buy the book and they might even buy it. I know Chegg was buying used, Book Renter was buying new, and if I buy that book as Book Renter at $85 and I can turn it, the first time, I can't sell it for $85 the first time, but maybe for $40, and the next time for $32.
It's okay,
and the
because
next
the
time
first
for $22.
time, if you're actually selling it in market, you're not making much money on it.
Yeah, but even in this case, they're taking a loss because they're doing the rental model. Because you have to give that book back at the end. And the idea is...
Well, not to mention all the logistics and distribution centers, and we can get to that, but
yeah,
there's a lot of infrastructure costs in this business.
That's true. And so I just want to say, so Chegg raised money. It says here they've done, so Chegg had previously raised money, which was $144 million in debt and equity. Book Renter just announced another $10 million. It was led by Norwest and Storm Ventures and Adams Capital. The total amount they've raised to date is $16 million. So what's going on in this sector? I mean, is everybody just buying used now?
Well, I think So this is a kind of a classic example of bringing efficiency to an inefficient market on the web. I think in many ways it's a Web 1.0 model. I'll qualify that in a moment, but a very powerful one. So, you know, students, textbooks are the third biggest piece of spending in the education sector. We know how big the education sector is.
Yeah.
So a ton of money is spent on textbooks every year. This is a model for the same books that are recycled over and over again, and maybe, a new edition comes out, but largely the same.
The new edition comes out so they can sell you the new damn book,
It's the same thing. It just uses the kind of marketplace dynamics of the web to make it far more efficient. So Netflix type model for books. It allows folks to get them used. Students don't care. These aren't books that they want to put on their bookshelves at the end of the day. They're stuff that they need to learn, and ultimately they're gonna give up.
Is there a fear? I know Kindle came out with a small version, and then they came out with a bigger version, and a lot of the media at the time was saying they were going to target the textbook market.
So
is there a way that they're getting in the wrong market?
So I'm going to get there, because I think that's the key question here. But I will say that first and foremost, it's a very powerful, and even the EDU institutions, the universities, have now gotten behind it where they weren't initially, because it's cutting the cost of education, and that is a very powerful thing. So fundamentally, if you can get a used book for much less than the cost of a new book, and you're not going to keep that book forever, it's a no-brainer. So the business is working. There's a lot of infrastructure, a lot of distribution that they've built. They're largely a logistics company, like Netflix was. We'll talk about that.
And logistics and financing, because they have to be able to finance.
The books. There's big working capital requirements. There's inventory requirements. They have to move stuff in and out of warehouses. It's like a serious operation. That's a core competency of the business. But it's churning cash right now because it works, and it's much better than the current model of buying new books every time. However, and the reason I say it's a Web 1.0 company is I think the Web 2.0 incarnation of how we're going to be educated and learn, and what textbooks or learning materials are going to look like in the future is very different than how it's being published and printed today. I think fundamentally it's going to be digital. And fundamentally, I think it's going to be dynamic and interactive and mixed media. And it's going to be a different type of experience. And I've seen some companies, there's a very interesting company on the West Coast called Inklink. We've seen a handful of others that are trying to help publishers rethink that and actually do that. So the danger with a Chegg or Bookrunner or any of these companies is the disintermediation challenge. You may, so the original market selling new books, now you have this great innovative model of kind of bringing that online, but doing it in a more efficient way and making a marketplace for used books. But fundamentally, you get leapfrogged by this entirely new technology that's a replacement technology.
I mean, it's interesting. I'll say this, and this is where I think we should take the conversation is, if I think about the deals I've been wrong on, and there have been some I'm just completely off base on. The biggest one on the top of my list would be Netflix, because it came out. I'm like, how the F do you get into a market that's so obviously disappearing, and yet it hasn't disappeared, and they've grown, and people want DVD. And my hypothesis was there's a short window, and I don't know if the window is 3 to 4 to 5 years, where finding people take DVD, but it's all going to be digital distribution, and that's true. But it turned out to be 10 years rather than 5, and Netflix in the process of becoming
huge. There's 3 reasons why you would, given the threat of disintermediation, invest in the category. And then we can talk about the company specifically. One is that it's going to take longer than people think. That solves kind of a runway cash flow problem. It doesn't solve necessarily an exit problem, because if you're going to take this thing public or somebody's going to buy it at the end of the day, those people need to believe that it's a sustainable business. Otherwise, you're not going to get the multiple. They're going to just look at the discounted value of your future cash flows, and it's a cash flow business and on this trajectory. The other things are, 2, you believe that they can make the Netflix style shift. So they can take this print business and use the built-in audience base to build a digital business.
Right. So it's the Netflix is now allowing digital downloads,
Correct.
And they're transitioning.
Instead of getting DVDs in the mail, you're pulling the
and in a way, Netflix now has market power because they're selling so many of them.
They have such a built-in install base that all of a sudden they switch to be a very large distributor.
Have pricing power with the
So two things about that. One is you got to hand the management team at Netflix just a tremendous amount of credit for being able to pivot like that.
Totally agree.
I mean, that is just an impressive company and an unbelievable story.
Yeah.
And we say it all the time that
it's the other
execution.
Reed, right?
Yeah,
it's Reed Hastings.
That execution is so fundamentally important. There's so many good ideas out there, but execution is where it's all at.
Yeah.
Is a classic example of that. So give them a ton of credit. The one difference I see between that market and this market, that there may be a handful, but one big difference is, there you're taking something that's delivered on a disc, you're taking the exact same thing and just putting it on the web and streaming.
Yeah.
So you need a CDN and you need some stuff and you need to host it and there's things you need to do, but that's largely commoditized at this point. I don't think that's true in the textbook world. Like, I don't think just taking a textbook and putting it on the web or making it digital with a few hyperlinks is how it's going to unfold.
So your assertion would be a Chegg or a book renter could win and create a long-term sustainable business if they can take the infrastructure that they build in the physical world and find the right way to pivot into the digital world. Because clearly textbooks are going digital.
No, I'd say if they can. They may have a chance to win if they can manage the decline in the infrastructure of the physical world, because that world will play no part in their new business. Like those warehouses don't mean jack when it comes to distributing.
Yeah, but Netflix has the same thing, right?
No, that's what I'm saying. Yeah. They need to manage that business as a cash cow, and they need to somehow pivot their company into a digital model, which means not just delivering the same inventory on the web, but rethinking and reinventing what a textbook looks like in a digital environment. And that is the area that I think is going to be the hardest for them to do as an incumbent, managing all that infrastructure, et cetera,
and
making the transition, and not just putting it on the web, but reinventing it for the web. That is a much tougher challenge. So that to me is the question there. That has a lot to do with the management team execution, looking at the startup environment, where the competition is going to come from, et cetera. The third thing I will say to finish the point, and I think is the wild card here, is the audience base. And I've heard this said a million different times, and it's very hard to pull off. But they take a Chegg or a book renter or whatever it is. They have a massive database of EDU email addresses and customers effectively. What can you do with that?
Okay.
That's the red herring here.
Right.
I don't know what they're thinking.
So
I haven't talked to them in a while.
Could there be third-party businesses?
Other ways to market to them.
Other ways to make money to those
There's
people.
15 different things.
So we need to move on. I do want to just ask, are we going to be cut off hard at the end of the hour, or can we overrun by 5 minutes?
Run over by 5
We can overrun. So we're going to have to move quickly through deals, Mo. I do want to say, so Chegg has raised 10 times the capital of Book Renter, and I think that'll be the challenge, but let's not go there.
Yep.
The next deal I'd like to talk about is called Trasler. I'm going to do this one really quickly, but I want to make sure we get through some of these. $1 million seed round. It's Adam Rugel, I hope I'm pronouncing that correctly, and Biz Stone, co-founder of Twitter. And what it's actually doing is creating an online travel guide served up in stream in the way Twitter is, with a restricted amount and Bitly and everybody else. Founder Collective, of course, we both know them, and AOL Ventures.
Yep.
What's going on with Tresner?
So very high level, great guy. Travel market is massive. Been a lot of innovation on the booking side, very little innovation on the planning side to date. Lots of people trying to go at the opportunity. You have a really smart guy going at it with a very focused social product, and very early, lots of early stage guys around the table.
Does it make sense to have 7 investors? I mean, what is it, like $499 each or something? I mean, like, why would you have 7 investors?
You know as well as I do that that's how these angel syndicates work. I think to the extent that you can get value out of all of them in the areas that they bring value, respectively, I think it's great.
But if they all own
certainly doesn't hurt you.
But if they all own 1.4% of your company, are they really
I don't know.
going to get out of it?
Does it harm him by having everybody? Are you asking the question about Adam or about the investors?
I'm asking both, because I have a belief that if you give 1.4%, I'm making the number up, 1.4% to 7 or 8 people, no one has enough skin in the game to allocate the kind of time that they need to help you succeed, with one exception, Mo.
Ron Conway.
No. Well, Ron Conway's Ron, right? I've taken to calling Ron the S&P 500,
okay,
right? Because Ron gets in every deal. So in a way, he's a bellwether for the industry, and you can't try to do 30% of Ron Conway, because that's like doing 30% of the S&P. If you're gonna model the industry, you got to do every deal. Everyone wants Ron, and everyone loves Ron. But aside from that, if you become Zynga and somebody owns 1.4% of you, they're going to kill themselves to help you, right? Or if you become Twitter, or if you become Facebook. But if you don't become an immediate success, and you have 7 guys who each own 1.4% of you, I sort of wonder.
I think it's fundamentally, it's a very individual question. I don't think you can answer it en masse. There are people out there that are angels, lots of companies, really add value. It depends how much time do they spend on this. Is it a full-time thing? Is it a part-time thing? It's so nuanced. It's very tough to answer. But
my recommendation, I'm going to take a harder line. If you are Adam Rugel, who I presume quite talented, was there at the start of Twitter, is surrounded by all sorts of people who have money and the ability to help him succeed, I think you can get away with it. If you're a first-time entrepreneur, I personally would choose to at least find one investor who has a little more skin in the game.
Sure.
And maybe the other people round out the 1.4.
Yeah.
But by the way, to be fair to these guys, that may be the case. I mean, it could be, for example, that, I don't know, Steve Case maybe has half the round, or I doubt it, but BetaWorks maybe has half the round. So
yeah, look, I'm all for having a lead investor who can really shepherd the company, but I don't think there's any downside in having a series of really smart, talented guys who you can tap into for advice, for their network, for just counsel, whether you're a first-time entrepreneur or a multi-time entrepreneur.
So I'm going to go through some deals and not ask you, because I have one deal I really want to ask you about. Hotlook raised money this week. It was $31 million, Series C, by Insight Venture Partners. What I find interesting, if everybody probably knows by now, because we talk about it all the time, because everyone's raising money, they compete with Gilt Group, they compete with Rue La La, it's this private shopping. I know the founder, I know they're doing incredibly well. Insight led their last round and led this round, and that's what I find most interesting about this deal.
Yep.
That they haven't brought in a new investor, and that they wrote a $31 million
That cuts
check.
both ways.
I know. We don't know what the deals are on that, but $41 million total raise. I suspect it was, we need to keep up with Gilt Group.
Matrix and GA just put more money into Gilt, and they're the existing investors.
So the other one that I don't want to talk about too much, because I want to ask you about one that I think you have some insight on. RockU also raised money. This is another example of previous investors putting in more money. Mm-hmm. RockU and Slide were the original widget companies that were going to capitalize on Facebook and all the social networks and getting users engaged with more than just the application itself. And somehow Zynga became the big company, but I'm told RockU's doing incredibly well still. And what they figured out was engagement. How do you engage people in an ad? And effectively, have they become an ad network, or is it?
They have a massive install base, and they have a massive ad network now.
And I spent some time with Lance Dakota. I found him to be incredibly bright and talented and thoughtful on the topic of how you engage users in the ad, because at a time where you had either just text links or banner ads, he was saying, no, the ad should be a quiz. The ad should be engagement. The ad should involve your social community. And I think that was the kind of magic to rock you. And Slide seems to have disappeared. Or am I wrong?
I don't know.
I don't
know, actually.
I don't hear much about Slide anymore, but that doesn't mean that they're not doing amazing. But I want to ask you about Pandora.
Okay.
Pandora raised money. Pandora was against the ropes. There was an idea that they might at one point go bankrupt. They've raised $56.3 million in total. It says undisclosed amount of investment, but the investors include GGV Capital and Allen & Company. They'd previously raised $35 million. They brought in a new CFO, Steve Cakebread.
Yeah,
I know him.
They're prepping for an IPO.
Steve used to be the CFO at Salesforce.com. That kind of led us through. And I think his family actually owns Cakebread Cellars, the winery in Napa Valley, although he never gave me any. And I guess Pandora competes with Spotify. Is that Last.fm? Or are they in a class? Are they in a class?
I think they compete with a lot of them. But I think Pandora, well, anybody that knows me knows I'm a big music geek. Pandora has done something very interesting. I'm not the biggest Pandora user because I find that Pandora, I hope this comes off right, but I find that Pandora is very self-reinforcing, meaning, you like X, so you get a lot more of things that are like X.
As opposed to new discovery?
Correct. Like, I'm much more focused on finding new stuff.
Where do you find new music?
I find new music from Hype Machine. Extension.fm is a company that we just seeded that I'm finding a lot of music from blogs, from other people.
Do you like music as a category to invest in?
I don't like it as a category to invest in generally, although I think there are pockets of opportunity.
Yeah.
But generally, it's been a very tough category for all the obvious reasons.
There's a lot of entrepreneurs I love in the category. There's Blip FM, there's Topspin Media. There's a lot of people trying to change it, but it's a tough industry to change.
And the thing about Pandora is, so they help you find music that's like other music that you like. They're effectively, it's a new kind of radio.
Yeah.
And people like radio because it's easy. The average person who's not a crazy music geek just likes to put something on that they like and hear other songs that they like too. And Pandora does that very effectively.
It's like Genius on
exactly.
Apple,
So with that, they've gone, legit the whole way. They've been paying the licensing streams. They don't have to pay the really onerous licensing fees because they're not allowing you to selectively play songs. So it's very much like radio.
Yeah.
They got a display ad model working, and increasingly, and I think this will be kind of a bigger trend on the web, they're doing in-stream audio ads, which I think eventually are going to have a very big place to play in music on the web.
Is Target Spot?
Target Spot is a company that's enabling that.
That's enabling that.
So that kind of thing is working, and I think if you have a very large mainstream audience, you provide them with a internet product that is easy to use and reinforces taste that they have, and you don't pay the ridiculous licensing fees, and you can get a model that works on the ad side, I think you'll come out the other end looking okay.
They have 50 million users.
It's a big number.
I've always heard the word, which is, the idea, which is that you tend to listen to music in life that you listened to when you were 30. So I'm a Pandora listener. I better really listen up then. I'm stuck in that Nirvana grunge, kind of world. Do you listen? You're in Boston. Do you listen to Zoe Radio? Do you know
Not
Zoe?
much. I don't. I'm not a big radio guy.
But this is. You should check it out. I think it's on the internet, and it's Ian Rogers who runs Topspin. It's his daughter is at MIT, and she curates a radio show. And everyone that I talk to who's kind of more avant-garde in music tells me to listen to it. I do listen to a little. I listen to some of the Austin radio stations occasionally, et cetera, online. But I listen to some. Actually, BBC has some interesting music out of the UK. If you have any interest in European or electronic music, it's kind of interesting. I lived there for 11 years. Exactly. We should finish here for two things. One is I want to say a big thank you to PickClick.com. Please go there, check it out. If you like what you see, maybe send out a tweet. Tell other people about it. We tend to like that company. And I want to say a big thank you both to Next New Networks for allowing us to film here today, and of course to Mo Koyfman, Spark Capital. Good to see you. Thanks a lot.